Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Huntsley, and if you love high conviction stock picks from right here in our own backyard, well, have we got the video for you today. Joining me is Casey McLean, Portfolio Manager for the Fidelity Australian High Conviction Fund. Welcome, Casey.
Hi, Hans. Thanks for having me.
So as I mentioned, you run a high conviction fund at Fidelity. So for you as an investor, what are some non-negotiables when you're identifying opportunities?
Well, the first thing we think about in terms of our core beliefs is that loss avoidance is the cornerstone to good investment performance. So when we're looking at a stock, the first thing we actually do is think about the stocks we don't want to buy. And broadly speaking, these are the low quality companies. So we assess them on a range of metrics such as the over leveraged, value destroyers, companies in earnings down cycle with highly volatile earnings. The next thing we do is the type of companies we want to buy generally score well on what we call the 5 S's. That's companies with sustainable competitive advantages, structural reinvestment opportunities, strong pricing power, supportive industry structure and superior management. So if you score well on that, we then assess the companies on the growth versus valuation, and we're looking for companies with medium-term earning growth or in earnings upcycle and a reasonable valuation relative to that growth profile.
5 S's, I like that. I might write that one down. So you may have heard Warren Buffett's favourite holding time is forever. What's yours?
Yeah, well, at Fidelity, we are fundamental long-term investors, but unlike Mr. Buffett, our holding period is not forever. We are active managers at the end of the day. But since I've been managing the High Conviction Fund, the turnover has been about 20%. So that suggests a holding period of around about 5 years on average. But like a lot of averages, it does hide a bit of the details. And if you pull it apart, really we have sort of two categories of stocks. We've got the compounders, where they're able to consistently grow their earnings above market growth rates, and we intend to hold those stocks for a very long period of time and kind of take an add and trim approach to those. The second are more the cyclical or growth opportunities, where the growth opportunity is shorter in nature, and those ones would have a shorter holding period overall.
So you're talking at the beginning about some of those companies that you avoid or ones that you immediately rule out. So with that in mind, what are some red flags that you look out for to know when a thesis isn't working anymore?
Yeah, well, I think the first thing to understand when a stock is not working is, has there been a cyclical or a structural change? If it's a structural change, that's likely to be a thesis breaker and would need to exit that stock. If it's more cyclical, you need to understand, firstly, where we are in the cycle. And is it that, we've bought in too early before the trough in the cycle and we can be patient, wait that out and perhaps buy more on weakness? Or is it that, we've held the stock, it's hit the peak of the cycle and it's now starting to turn down. And if we see a deep cycle coming, that's probably another time to exit the stock. But some other sort of indicators that we try and get a leading indicator on some of these changes are things like short interests. The guys shorting, they're smart, sophisticated investors. They're putting their money where their mouth is. So you need to think about what do they know that I don't know. Secondly, similarly, it's insider selling. They've got asymmetric information. What does that tell you about the stock? And we're also looking for divergent earnings estimates. That's where the range of earning estimates is widening. And that can be a leading indicator in both directions of upgrades or downgrades in earnings as well.
Right. I think we've kept the readers and the viewers waiting long enough. Get your pen and paper out, everybody. Time to put you to work, sir. What are some businesses that you are excited about for the next 5 years?
Well, I think in the large cap space, we like CSL. It is one of those compounders that I talked about. If you look at their history, they're able to compound their earnings at about 20% over a 30-year period. And that's really driven by their innovation and R&D spending. And we don't think anything has fundamentally changed there. They should be able to grow their earnings around mid-teens, we think, over the long term. And at the moment, that's really driven by that core plasma business, CSL Behring, where we're seeing collection volumes increase. Their yields are also improving through some initiatives they're putting in place, like the new RECA bed rollout and also I think called individualised nonogram, where they can adjust the amount of plasma that you take based on your height, weight and red blood cell count. And then also, donor fees are sort of moderating as well in the industry, as some of their competitors are under a bit of pressure as well. So we can see margin improvement there. This sort of comes at a time when, recent acquisition they made, CSL Vifor, it's not performing that well. But we still see that business as having the potential to grow their earnings double digit over the longer term as well. And then you've always got this emerging pipeline of innovative drugs at various stages of approvals as well that are coming through to support those earnings. So it's a stock we think that can grow at sort of 15% for the medium term and trades on about 25 times earnings. And when you compare that to some of its large cap peers, it looks quite attractive.
So that's CSL. You got another one for us?
Yeah, I mean, in the smaller cap segment of the market, we like a company, Siteminder, who are a channel management software provider for hotels. And the value proposition really is there to maximise hotels' revenues by getting the best price for your room, but also lower your costs by taking out the manual processes that they use to do that now. They're targeting to grow at 30% over the long term through a combination of user growth, getting more hotels where they're still quite low penetrated, and also increasing the ARPU by rolling out new products. So they have a couple that are coming to market at the moment. Dynamic Revenue Plus, which is a price optimization engine, which allows hotels to get the best price per room, and also Channels Plus, which allows them to automatically connect into all these range of online travel agents as well. So it's a company that's just broken even. We think its earnings are going to grow much faster than its revenue. Trades on around about 6 times EV to sales. But if they do hit those 30% growth rates or rule of 40, which you can see potentially in a few years, there is scope for further re-rating there. Another one we like similarly sort of in the more smaller cap space in a different segment is Polynovo, who's a biotech company who has a product called Novosorb, which is a biodegradable polymer used to treat severe burns. It's a pretty large market. It's about $1.2 billion TAM. They're at the fairly early stages of penetrating that market. They've got market-leading share in countries like Australia, the UK, Germany. But really the growth is about rolling out to more hospitals in the US, which is the largest market, and penetrating deeper into those hospitals, plus also rolling out into new countries, other new big markets like India and the rest of Europe as well. But what we also like about this company is we consider it kind of a platform technology. So they're able to use this technology into multiple different indications like trauma or hernia surgery, breast reconstruction, diabetic foot ulcers, and they're at the very early stages of penetrating that as well. So again, it's a company that's just broken even. I think earnings, it's been growing revenue at 60% sort of type rates, continue to grow at a fast pace, and it has pretty attractive market to grow into.
And just quickly, just to round this all up, I know that you do hold CBA and NAB, 2 of the top 5 positions in the portfolio, but the banks have had a remarkable run over the last year or so. What is your outlook for the big banks?
Yeah, well, I think the context there, Hans, is we are underweight the banks.
Sure.
NAB is the only bank that we are overweight in the portfolio. The reason that we prefer NAB is because they have a bigger weighting to business banking. Business banking is really the only part of the banking landscape where you're able to generate a good return. They're making around mid-teens sort of ROE in this business. They're far more overweight that than the other major banks. We've seen that they've been able to grow that business by really focusing on the whole of customer. So getting to be the first choice bank for these business banks. So able to do their lending, their payments, their transactions, their cards as well. And so it means you're able to grow your lending in line with the deposits. So you have the cheapest source of funding, but also it gives you the data and analytics into these customers because you see their cash flows coming into the accounts. And ultimately it means you're able to have better insights into their credit and risk profile as well. And then the other thing we like about them is really their focus on the proprietary channels. That's loan origination outside of the mortgage broker channel. And that obviously comes at much higher returns, and that's a key focus for theirs as well. So it's a company that has the sort of second highest returns in the market out of the major banks, and it is sort of the emerging and increasing quality bank amongst the 4.
Beautifully explained. Casey McLean of Fidelity International, thank you very much for joining us. And thank you for joining us. If you enjoyed that interview, of course you did. You can subscribe to the Live Wire Markets website as well as our YouTube channel where you can find more episodes of The Pitch. We'll see you again soon.